Good morning all of you. I am Parsuram Shukla, Training Associate Economics, KVS JIT Bhubaneswar. Welcome to my economics class. Today I will be presenting the 7th video lessons in respect of Unit 1 of Class 12 Macroeconomics. In my 6 previous video lessons in respect of this Unit 1 Class 12 Macroeconomics, I have presented all the basic concepts of macroeconomics, value-added method and income method, and also the national income and its related aggregates. If you have missed my video lessons, you may watch all the video lessons. The link to all these are given in the description box given below. So today I will be discussing the chapter 7 of estimation of national income by expenditure method. So the content to be covered in this video lesson: concept of expenditure method, components of final expenditure, steps of expenditure method, precautions of expenditure method, reconciliation of all the three methods of measurement of national income. The learning objectives: at the end of this video lesson, you will be able to state the meaning of expenditure method, classify the components of final expenditure, explain each component of final expenditure, identify the steps to calculate final expenditure as well as the domestic and national product or income, state the precautions while calculating national income using expenditure method, reconcile all the three methods of measurement of national income. As you all know, factor income earned by factors of production is spent in the form of expenditure on purchase of goods and services produced by firms. So in this method, the national income will be measured as the sum total of final expenditure incurred by households, business firms, government and foreigners. This total final expenditure is equal to gross domestic product at market price, that is GDP MP, that is the summation of final expenditure is equal to GDP MP. This method is also known as income disposal method. The components of final expenditure in an economy: expenditure is undertaken by all the sectors, that is households, government, firms and the foreign sector. The components of final expenditure you can see here: private final consumption expenditure, government final consumption expenditure, gross domestic capital formation, which is categorized as gross fixed capital formation plus inventory investment. And the fourth component of this final expenditure is net exports, and it is equal to exports, that is X, minus imports, that is M, that is X minus M is equal to net exports. Private final consumption expenditure, as it is the first component of the expenditure method, that is PFCE. It refers to the expenditure incurred by households and private non-profit institutions serving households on all types of consumer goods, that is durable, semi-durable, non-durable goods and services. The private final consumption expenditure is equal to household final consumption expenditure plus private non-profit institutions serving households final consumption expenditure. The expenditure incurred on purchase or construction of owner-occupied houses, and it is treated as capital formation included under gross residential construction investment and not as durable consumption. Other costly consumer durables, cars, air conditioners, washing machines, etc. are included under private final consumption expenditure. The government final consumption expenditure, GFCE, this is the second component in the expenditure method. It refers to the expenditure incurred by general government on various administrative services like defense, law and order, education, etc. Government produces goods and services with the aim of social welfare without any intention of earning profits. Estimation of government final consumption expenditure, GFCE. GFCE is equal to cost of goods and services produced by government for collective use by the public. These services are valued at their cost to the government as they are not normally sold to the public. It means government final consumption expenditure is calculated as intermediate consumption of the government plus compensation of employees paid by government plus direct purchases from abroad for embassies and consulates located abroad minus sale of goods and services produced by general government. Gross domestic capital formation, GDCF or gross investment. This is the third component in the expenditure method. It refers to the addition to capital stock of the economy. It represents the expenditure incurred on acquiring goods for investment by the production units located within the domestic territory. Components of Gross domestic capital formation. Gross fixed capital formation is the first component. It refers to the expenditure incurred on purchase of fixed assets. This expenditure is generally divided into three subcategories. That is gross business fixed investment. It includes expenditure on the purchase of new plants, machinery, equipments, etc. Gross residential construction investment. It includes expenditure on purchase or construction of new houses by the households. Gross public investment. It includes expenditure on construction of flyovers, roads, bridges, etc. by the government. Then the second component of gross domestic capital formation is inventory investment, that is change in stock. It refers to the physical change in the stock of raw material, semi-finished goods and finished goods lying with the producers. It is included as an investment item because it represents the goods produced but not used for current consumption. It is calculated as the difference between the closing stock and the opening stock of the year. It means GDCF, that is gross domestic capital formation, is equal to gross fixed capital formation, GFCF plus inventory investment, or gross domestic capital formation is equal to gross business fixed investment plus gross residential construction investment plus gross public investment plus inventory investment. This gross business fixed investment, gross residential construction investment, gross public investment, these three is equal to gross fixed capital formation. So in a flow chart, you can understand in a better way gross domestic capital formation or gross investment, gross fixed capital formation and inventory investment, that is change in stock. Gross fixed capital formation, as I told in the previous slide, the gross business fixed investment, gross residential construction investment, gross public investment. Inventory investment, that is change in stock, is equal to closing stock minus opening stock. Net exports is equal to difference of X minus M, that is exports minus imports. It refers to the difference between exports and imports of a country during a period of 1 year. Exports, that is X, refers to the expenditure by foreigners on purchase of domestic products. The exported goods have been produced within the country's domestic territory, so they are included in output of an economy. Imports, that is M, is the expenditure by residents on foreign products. Imports are deducted to obtain domestic product as they are not produced within the domestic territory. Instead of treating exports and imports separately, the difference between the two is taken and is termed as net exports. So in a better way, you can understand that is there may be the confusion of net exports and net factory income from abroad. So there is a comparison between net exports and net factory income from abroad. So net exports, it refers to difference between the exports and the imports of goods and services, whereas NFIA, it is the difference between factory income received from abroad and factory income paid abroad. Net exports is a domestic concept, whereas NFIA is a national concept. Net exports includes non-factor services, whereas NFIA includes the factor services. So the steps in calculating national income or national product by expenditure method. In the step 1, we have to identify the economic units incurring final expenditure. All the economic units which incur final expenditure within the domestic territory are classified under 4 groups, that is household sectors, government sector, producing sector and rest of the world sector. In the step 2, we have to classify the final expenditure. Final expenditure incurred by the above mentioned economic unit, that is household, government, producing sector and the rest of the world sector, can be classified under the following heads, that is private final consumption expenditure, PFCE, government final consumption expenditure, GFCE, gross domestic capital formation, GDCF and net exports, that is X minus M or exports minus import. The sum total of 4 components of final expenditure gives gross domestic product at market price, that is GDP at market price, that is PFCE, private final consumption expenditure, government final consumption expenditure, gross domestic capital formation and X minus M. And GDCF, as you have already clarified, gross fixed capital formation plus change in stock is equal to gross domestic capital formation. In step 2, we have to calculate the domestic income, that is NDP at factor cost, by subtracting the amount of depreciation and net indirect taxes from gross domestic product at market price. We get the domestic income, that is shown here. NDP at factor cost, that is domestic income, is equal to GDP MP minus depreciation minus net indirect tax. In step 4, we have to estimate the net factory income from abroad to get the national income. In the final step here, the NFIA is added to domestic income to arrive at the national income. That is, national income is equal to NDP at factor cost plus NFIA. National income, as you know, that is known as NNP at factor cost is equal to net domestic product at factor cost plus net factory income from abroad. So this can also be presented in a flow chart, the summary of expenditure method. So here you see private final consumption expenditure plus government final consumption expenditure plus gross domestic capital formation plus net exports is equal to gross domestic product at market price. From this GDP at market price, if you deduct depreciation and also deduct net indirect taxes, we are getting this NDP at factor, that is domestic income. And to the domestic income, if we add this NFIA, then we get the national income, that is NNP at factor. So precautions while calculating the national income by expenditure method, the various precautions to be taken while using the expenditure method are expenditure method on intermediate expenditure on intermediate goods will not be included in the national income. Transfer payments are not included, as such payments are not connected with any productive activity and there is no value addition. Purchase of second hand goods will not be included. However, any commission or brokerage on such goods is included, as it is a payment made for the productive service. Purchase of financial assets, shares, debentures, bonds, etc. These are the financial assets, will not be included. However, any commission or brokerage on such financial assets is included, as it is a productive service. Expenditure on own account production, the imputed value of the owner occupied houses will be included in the national income, since these are productive services. The reconciliation of the three methods, value added method, income method and expenditure method. So in value added method, we have had this gross value added at market price by primary sector, by secondary sector, by tertiary sector. All these three are added to get the gross domestic product at market. From gross domestic product at market price, if we deduct the depreciation and the net indirect taxes, we get the domestic income, that is net domestic product at factor. To net domestic product at factor cost, if we add this NFIA, we get the net national product at factor cost, that is national income. In income method also, all the factory income to be added, that is compensation from employees, and the rent, royalty, interest and profit, that is the operating surplus, and the mixed income. These are the three components of the income method. So if we add these three, we get the domestic income, that is net domestic product at factor. So to this, we add NFIA to get the NNP at factor. In expenditure method, we add all the components of the expenditure, that is final consumption, private final consumption expenditure, government final consumption expenditure, gross domestic capital formation and net exports, all the components in the expenditure method to get the GDP at market. So from GDP at market price, if we deduct depreciation and the net indirect taxes, we get this NDP at factor. To NDP at factor cost, if we add this NFIA, we get this NNP at factor cost, that is the national income. So like this, we can have a reconciliation of all these three methods to get this national income or net national product at factor. See examples to clarify some doubts. You see the example, you can note it in your notebook, or you can see minutely. The examples for reconciliation of these three methods: from the following data, calculate the national income by value added method, income method and expenditure method. You see these items: gross value added by market primary sector, gross value added by secondary sector, gross value added by tertiary sector, compensation of employees, rent and royalty, interest, mixed income, profit, private final consumption expenditure, government final consumption expenditure, gross domestic capital formation, net exports, net indirect taxes, depreciation, net factory income from abroad. So if you see these examples, and the values are also given here on the right hand side of this column. So if you see these examples, you see some of the items are related to value added method, some of the items are related to income method, and some of the items are related to expenditure method, and some items are here which are used in all the methods like NIT, that is net indirect tax, depreciation and net factory income from abroad to get the national income. So you see the examples, the solution: national income by value added method, national income by value added method, that is the first three items. You see the item here, gross value added by primary sector, secondary sector and tertiary sector, the item number 1, 2, 3. So if you add these three, then you are getting the gross domestic product at market price. If you deduct this depreciation from this GDP at market price, you get the NDP at market price. From NDP at market price, if you deduct the net indirect taxes, you get the NDP at factor cost. To NDP at factor cost, if we add this NFIA, we get this NNP at factor. So it is clarified here. You see, as I just now told, GDPMP, then NDPMP. From NDPMP, you come down to NDPFC, and then again finally NNP at factor. So national income, in the income method, you see the item number 4, 5, 6, 8 and 7. Why this 8 and 7? Because you see the item here, 4 is compensation of employees, rent, royalty, interest, and profit is the 8th item. So rent, royalty, interest and profit gives us the operating surplus, and mixed income is separate component of this income. So if you add this, you get this NDP at factor cost, and to NDP at factor cost, if we add this NFIA, we get this NNP at factor. You see the value 4200 here in value added method, and in income method also 4200 the result. Then in expenditure method, you see the item number 9, 10, 11 and 12. You see all the expenditure item here: private final consumption expenditure, government final consumption expenditure, gross domestic capital formation and net exports. If you add this, you get this GDP MP, already clarified. Then from GDP MP, if you deduct this item number 14, what is 14 here? You see 14 is depreciation, and NIT, that is net indirect tax, is in the 13th item. So you see GDP MP minus 14, that is that is the depreciation, and item number 13 is depreciation, that is net indirect tax. Item number 14 is depreciation. So GDP MP minus depreciation, you get this NDP MP, and NDP MP minus NIT, that is NDP FC. To NDP FC, if you add this NFIA, that is item number 15, you get this NNP at factor. So the result is 42. So reconciliation shows here in all the three methods the value of NNP at factor cost, that is national income, is same. That has to be noted by all of them. Then as usual, some questions are here as homework. What is final consumption expenditure? Distinguish between net exports and net factory income from abroad. Distinguish between final expenditure and intermediate expenditure. Change in stock is not a part of capital formation. True or false? Give reason. Exports are a part of net factory income from abroad. True or false? Give reason. And I have mentioned here 1 mark, 3 mark and like this, because these are the pattern in which the questions are asked in the board exam. See you all in my next video on the chapter real and nominal GDP, GDP and welfare. Don't forget to give your feedback to my mail ID parsuram.shukla@gmail.com, and in my WhatsApp number you can give the feedback, that is 9938649454. I hope you are benefited by this educational videos. So kindly like, share and subscribe so that next videos reach you immediately. Thank you for watching my video. Thank you all.